Two investors, same goal, same market. One buys solo, full control, full responsibility, all on their own. The other buys with a partner, shared deposit, shared risk, shared decision making. 5 years later, one of them wishes they had done it differently. And it's not always the one you would expect. Buying with a partner, whether that is a spouse, a friend, a sibling, or a business partner, is one of the most consequential decisions an investor can make. Get it right and it accelerates everything. Get it wrong and it can damage your finances and your relationship for years. So today we are covering both sides honestly so you can make the right call for your situation. Hi, I'm Ankit from ValueNest Buyers Agency and I specialize in research-led property investment strategies. I help property investors make confident, data-driven decisions by focusing on numbers and fundamentals, not the headlines. So let's get into it. Buying solo. You purchase in your name alone, you make every decision, carry all the financial responsibility and keep all the upside. Your borrowing capacity, your deposit, your risk, everything. Buying with a partner, you purchase jointly with another person. That could be a romantic partner, a family member, a close friend, or a business associate. You pool resources, share costs, and split ownership. Both structures have genuine advantages. Both come with risks that most people don't think through carefully enough before they sign the contracts. Now let's go through them properly. So let's start with buying solo and make the case properly. The first advantage is control. So when you are buying alone, you make every decision: which property to buy, which suburb to buy in, when to sell, whether to renovate, what rent to accept. Everything is managed by you and owned by you. You don't need to consult anyone. You don't need to compromise. You don't need to wait for someone else to be ready. For investors who have a clear strategy and the discipline to execute it, that autonomy is genuinely valuable. The second advantage is simplicity. One name on the title, one decision maker, one set of financial circumstances to manage. There are no disputes about strategy, no disagreements about when to sell, no awkward conversations when one partner wants to exit and the other doesn't. The third advantage is flexibility. Your financial position is yours alone. If your circumstances change, if your income grows, if you want to refinance, or if you want to leverage equity into a second property, you can act without needing agreement from anyone else. Solo ownership gives you the ability to move quickly and decisively. And in property, timing often matters. And for some investors, going solo builds something beyond wealth. It builds confidence. The knowledge that you did it yourself, found the property, secured the finance, made it work, is something that no co-ownership arrangement can replicate. Now, let's look at the limitations of buying solo. Comes with real constraints, and pretending otherwise helps nobody. Borrowing capacity is the biggest one. Two incomes will almost always qualify for a larger loan than one. In markets where entry-level investment properties start at 700 or 800K, a single income can make it difficult to get into the right suburb at the right price point. The deposit burden falls entirely on you. Saving a 20% deposit on a 800K property, say 160K, and then other legal costs including stamp duty, while covering your own living expenses and existing financial commitments, takes time, often years. And the cash flow pressure is real. Mortgage repayments, rates, insurance, property management, maintenance, all coming out of one income. In the early years specifically, this can be a significant strain. Emotionally, solo investing can be isolating as well. There's nobody to share the wins with, nobody to talk about decisions you have to go through, nobody to carry the load when things get hard. For some investors, that's fine. For others, it becomes a grind. Now let's make the case for buying with a partner. Because done right, this structure can genuinely accelerate your property journey. The most obvious advantage is combined borrowing power. Two incomes mean a larger borrowing capacity that opens the door to better suburbs, strong growth corridors, and higher quality assets that neither party could access alone. The deposit becomes achievable faster. Two people saving towards the same goal with a shared timeline and shared accountability can reach a deposit in half the time of going solo. Shared holding costs change the cash flow equation completely. When mortgage repayments, rates, and maintenance costs are split, the monthly burden becomes far more manageable. Properties that would be negatively geared on a single income can become neutral or even positively geared when it comes down to the income of two. There's also a strategic advantage in shared decision making. A good partner challenges your thinking. They ask questions you haven't considered. They show you down when you are about to make an emotional decision and push you forward when you are being overly cautious. Two sets of eyes on a purchase done well produce better decisions than one. And for first-time investors especially, having someone alongside you reduces the fear. Taking the first step into property is daunting. Doing it with someone who shares your goal and your risk makes the leap feel manageable. Now let's look at the risks, and I want to spend some real time here because this is where I've seen investors make decisions they deeply regret. Firstly, relationship changes. Ownership doesn't. You might buy with your best friend today, and in 3 years, they've met a partner, their life has changed and they want out. You might buy with a romantic partner and the relationship ends. You might buy with a sibling and a family disagreement creates tension that makes every decision about the property loaded with emotion. The property doesn't care about any of that. The mortgage still needs to be paid. The decisions still need to be made. Exit is the conversation most co-owners never have before they buy, and it's the most important one. What happens if one partner wants to sell and the other doesn't? What happens if one partner loses their job and they can't meet their share of repayments? What happens if one partner wants to renovate and the other disagrees? What happens if one partner dies? So these are all real questions. These are not pessimistic questions. They are actually essential ones. Misaligned strategy is a silent killer. One partner wants to hold for 20 years. The other wants to sell in 5. One wants to buy in Queensland, the other wants to buy in Sydney. These misalignments seem manageable before you buy, but become serious problems after. And financially, your credit is linked. If your co-owner misses repayments for any reason, your credit rating takes the hit too. Your financial future is now partly dependent on someone else's behavior. This is not a small thing. So if you are going to buy with a partner, and many investors absolutely should, here are the non-negotiable conversations you have before you sign anything. First one, exit strategy. How long are we holding? What triggers a sale? What happens if one of us wants early? Who has first right to buy the other out, and how the property valued at that point? Secondly is decision making. Who has the final say on major decisions? How do we resolve genuine disagreements? What decisions require both signatures and what can one person action alone? Number 3, financial scenarios. What happens if one of us loses income? How do we corner shortfalls? Do we have a cash reserve for maintenance and vacancy? Who manages the day-to-day finances? Number 4, legal structure. Are you buying as joint tenants or tenants in common? These are legally different, and the difference matters enormously if a partner passes away or if you want to own unequal shares. Number 5, document everything. A co-ownership agreement drafted by a solicitor is not excessive, it's essential. It costs a few $1,000s and can save you tens of thousands and a relationship if things go sideways. These conversations are uncomfortable in the beginning, but still have them anyway. Now let's put both the scenarios side by side. Borrowing capacity, solo, limited to single income with a partner, significantly higher combined capacity. Deposit timeline. If you go solo, longer to accumulate a loan, and if you go with a partner, faster with pooled savings. Let's look at the cash flow pressure. Solo, all costs fall into one income. With a partner, shared and more manageable. Decision making. If you go solo, full autonomy, move fast. Go with a partner, requires alignment, can slow decisions. Risks. If you go solo, you carry it all. Go with a partner, it's shared, but also linked to someone else's circumstances. Exit flexibility basically. If you go solo, sell whenever you choose. With a partner, requires agreement or legal process. Relationship risk. Go solo, none. With a partner, real and should never be underestimated. So let's look at an honest summary of what we discussed earlier. Buying with a partner can get you into better properties faster with less financial pressure, but it includes complexity, relationship risks, and a loss of autonomy that solo investors never have to manage. So neither is better. They suit different people at different stages of life. So how do you decide? Buy solo if you have the borrowing capacity to get into the right market without a co-owner. You value autonomy and speed above all else. You don't have a partner whose financial discipline and strategy you fully trust, or your personal circumstances, income stability, existing assets, risk tolerance means you are genuinely better positioned alone. But with a partner, if you need combined income to access the right market, you have a partner whose financial values and strategy genuinely aligns with yours. You've had the hard conversations, exit, decisions, financial scenarios, and you are both clear on that. And you have a legal agreement in place before you buy. And one more thing worth saying, buying with a romantic partner and buying with a financial partner are two very different decisions with very different emotional stakes. If you are buying with someone you are in a relationship with, the financial and emotional are inseparable. Make sure you have separated them clearly enough to have honest conversations about both. Now here is the truth. Some of the best property portfolios I have seen were built by solo investors who were disciplined, patient, and clear on their strategy. And some of the best portfolios I have seen were built by partners who complemented each other perfectly. Different strength, shared goals, and total trust, which is very, very important. Now, the structure doesn't determine the outcome, the preparation does. Whether you are buying alone or with someone else, know your strategy, know your numbers, and know exactly what you are signing up for before you sign anything. If you are working through this decision right now and want a clear-headed conversation about what makes sense for your situation, reach out. The link is below. And if this gave you something useful, please subscribe. New video every week, no fluff, no hype. Thank you for watching this one. See you in the next one.